So it was just over a year ago that the World Health Organization declared the coronavirus pandemic. Markets continued to sink aggressively after that, right up through March 23rd. And then we started to see the rebound. But if you look at it on a last 12 months basis from the end of the first quarter, okay, and admittedly, this is after a sell-off. We had just incredible returns. It tells us a couple of things. One is that, I mean, there's the old saw, don't fight the Fed. Well, don't fight asset markets when governments are pushing trillions of dollars into the economy. So what can we look for going forward? You know, one of the things that people will almost invariably say when discussing the outlook is it's a very uncertain environment. That said, there are a number of things that we can state with utter certainty over the next couple of months. And the first one is that vaccine distribution will continue to accelerate in the United States. And as a result, we're going to see just a huge increase in economic activity. And hand in hand with that, we're going to see a big increase in inflation measures. And then the third thing that we can state unequivocally is that earnings are going to soar for many of the companies. The more interesting question is, how does this continue after that initial spike in enthusiasm and ebullience, if you will? There are, of course, some other politically or government-inspired issues that are entering the calculus, and will have an effect on not only how the overall market performs, but also when you look at things like the infrastructure, will have a significant impact on the types of companies, the sectors that we see the strongest performance.
Well, I mean, I think the biggest thing that stands out was the rotation that you found between value and growth. Really, growth companies, i.e. technology, really did well last year on the COVID stay-at-home theme. And as optimism grew in the economy, then I think the rotation began to happen, not only because of the optimism, but also because a lot of people felt there was inflation on the horizon. So one of the things that's happened in the first quarter, which is of note, is that the dollar began to increase in value. And what you find is that whenever the dollar does increase, emerging markets actually go down in value. And that was typical of this year as well. So last year, for example, when the dollar was going down, emerging markets did quite well. And first quarter this year, when the dollar began to increase in strength, you had the opposite happening.
The byproduct of all this U.S. fiscal program and anticipation of improved economic activity, in part driven by the $1.9 trillion fiscal program, has led the Treasury market to experience a dramatic rise in rates. Because of the changes in the interest rate complex, that also affects emerging markets and other areas where the participation fund invests. The Middle East, or rather the GCC region, continues to provide a favorable investment climate for the participation fund. That region, which comprises of 6 countries such as Bahrain, Oman, Kuwait, Qatar, Saudi Arabia, and UAE, are the primary source of most Sharia-compliant investment certificates known as sukuk.
Performance data quoted herein represents past performance and is no guarantee of future results. Investment return and principal value of an investment will fluctuate so that an investor's shares, when redeemed, may be worth more or less than their original cost. Current performance may be significantly higher or lower than data quoted herein. Performance current to the most recent month end can be obtained by visiting amanafunds.com or by calling toll-free 1-800-728-8762. Please consider an investment's objectives, risks, charges, and expenses carefully before investing. To obtain this and other important information, which you should carefully consider before investing, about the Amana funds in a free prospectus or summary prospectus, please visit amanafunds.com or call 1-800-728-8762.